These are millions of American homeowners who woke up one day to find their homeowners' insurance companies had simply walked away. No warning, no negotiation, just a cancellation notice in the mail, and suddenly decades of premium payments meant nothing. If you live in what's now called a red zone, areas designated as high risk for wildfires in the wildland-urban interface, you're experiencing the collapse of America's home insurance system in real time, and the numbers are staggering. In just 5 years, from 2018 to 2023, insurers canceled nearly 2 million homeowner policies in the face of rising climate risks. That's over 4 times the number that would normally be expected in an entire year. But here's what makes this crisis particularly devastating. It's not just about finding new insurance. It's about the complete transformation of how we think about homeownership, community stability, and the American dream itself. Let me tell you what's really happening in these red zones, starting with the moment everything changed. The year 2017 triggered this entire crisis. CAL FIRE reported that 9,270 fires burned nearly 1.6 million acres across California and destroyed approximately 11,000 structures. Insurance companies looked at those catastrophe modeling data and made a collective decision that would reshape the housing market forever. The dominoes started falling fast. In November 2022, Allstate announced it would pull back from offering new insurance in California. Then on May 26, 2023, State Farm, California's largest insurer, covering over 2 million homes, announced it would no longer accept new business. Just over a month later, on July 3, 2023, farmers began limiting new homeowner policies. But the real shock came in March 2024 when State Farm announced it would not renew 72,000 existing home and apartment policies in California. That's 2% of all their policies in the state. By September 2024, State Farm projected they would have 1 million fewer policies by 2028. Think about that for a moment. We're not talking about a company being picky about new customers. We're talking about insurers actively shedding existing customers who had been paying premiums for years, sometimes decades. As traditional markets tightened, the excess and surplus lines insurance market became a lifeline. Surplus lines insurers, including carriers like Lloyd's of London, began stepping in where traditional insurers retreated, though at significantly higher costs. Scott Campbell experienced this firsthand when he purchased a home in Utah's red zone 3 years ago. When we bought this house, they just said, "You're in a fire zone." And I said, "You've got to be kidding me." You would have thought they had come to look. Campbell couldn't find coverage initially and got dropped by his insurer after just the first year. When I bought this house, the first week I did not have insurance. I couldn't find it. Now, you might be wondering, what exactly qualifies as a red zone? Utah's Division of Forestry, Fire and State Lands released maps called the High-Risk Wildland-Urban Interface, which identify red areas as those with structure risk scores of 7 or 8 out of 8 and containing at least 2 structures within an 820-foot radius. In California, these are officially called Fire Hazard Severity Zones. Essentially, if you live near open space that could burn, you're now considered uninsurable by many companies. The financial reality behind these decisions becomes clear when you look at recent wildfire costs. The January 2025 Los Angeles fires, the Eaton and Palisades blazes that devastated Pacific Palisades and Altadena, are now the costliest set of wildfires in global history. Economic damage estimates range from $250 billion to $275 billion, with $40 billion in insured damage alone. That makes these 2 fires the most expensive wildfire events ever recorded for the insurance industry. Individual insurers are hemorrhaging money. Chubb reported the LA wildfires cost them $1.5 billion pre-tax in the first quarter. AIG estimated their net loss at approximately $500 million. State Farm faced over $7.6 billion in projected payouts from just the January fires, a figure that nearly doubled the insurer's previous highest single-year losses from 2017. As Jim Tolliver from Woodruff Sawyer puts it, everybody's cherry-picking, and they're going to be careful about sticking their neck out on anything they think that's going to have a total loss. This selective insurance underwriting process has left entire communities without viable options. The human cost of this cherry-picking is devastating. A nationally representative 2025 survey found that 1 in 4 homeowners had their policies canceled in the previous 12 months. Another survey found that 1 in 7 homeowners don't have coverage at all. For those who can still find insurance, the costs have become crushing. The average cost of homeowner insurance nationally has jumped between 30 to 40% in the last 5 years. In Florida, the average premium increased by $1,450 between 2020 and 2023. Florida's premiums are projected to rise another 9% in 2025, reaching an average of $15,460 annually. But even these numbers don't capture the full picture. Some homeowners in the highest risk areas now pay a 50% wildfire deductible on their dwelling coverage. One consumer from Connecticut told Consumer Reports, "Homeowners insurance now costs my family more than food, heating oil, and electricity combined." When traditional insurers abandon these areas, homeowners get forced into what's called the insurer of last resort, state-run FAIR plans. California's FAIR plan has seen explosive growth, with the number of policyholders jumping more than 20% last year to over 350,000. The plan's liability exposure has grown from $50 billion in 2018 to $336 billion as of February 2024. Here's the irony. FAIR plans were originally created as a Band-Aid response to a very different crisis. California's FAIR plan emerged from the Watts Uprising of 1965, designed to provide basic coverage when private insurers fled urban areas. Now, 60 years later, these same emergency measures are being overwhelmed by climate-driven disasters. Alfonso Pating from the Natural Resources Defense Council explains the problem. It was supposed to be a stopgap measure. People are supposed to be on a FAIR plan policy for a short amount of time, but with climate change and these extreme weather events, that's not going to happen. The strain on FAIR plans is enormous. After the January 2025 LA fires, California's FAIR plan faced an estimated $4 billion in losses and had to request a $1 billion assessment on all insurers operating in the state. FAIR plan coverage has expanded 300% since 2021, and nationwide, FAIR plans now cover nearly 3 million properties with exposure exceeding $1 trillion. The ripple effects extend far beyond individual homeowners. The California Association of Realtors found that nearly 7% of real estate deals fell out of escrow in 2023 because buyers couldn't find affordable insurance. Entire communities are seeing property values stagnate or decline as the cost of insurance becomes prohibitive. Lacey Garrison-Strom, an executive at Heffernan Insurance Brokers, describes the reality facing insurance agents. The scale of this fire is so vast, we've experienced nothing like it. Brokers are very limited in the options we can provide for a home that's in the highest red zone you can find. In some cases, we just can't solve that situation. The insurance industry argues they're simply responding to mathematical reality. Climate change has fundamentally altered catastrophe modeling calculations, and in many cases, the cost to insure properties exceeds what consumers can afford to pay. Allstate specifically cited California's Proposition 103, which requires regulatory approval for rate increases, as preventing them from charging rates that reflect actual risk. But regulators and consumer advocates see it differently. California Insurance Commissioner Ricardo Lara implemented emergency protections, stating, "Losing your insurance should be the last thing on someone's mind after surviving a devastating fire. This law gives millions of Californians breathing room and hits the pause button on insurance non-renewals while people recover." Lara's sustainable insurance strategy aims to balance market stability with consumer protection. The situation has become so dire that some officials describe it in apocalyptic terms. As one former California official put it, "The insurance crisis in the U.S. is the canary in the coal mine, and the canary is dead." There are some signs of potential stabilization. Data from Matic reveals a 69% increase in available insurance quotes per person from March 2024 to July 2025. The excess and surplus insurance market, typically used for unique or high-risk properties, has become a lifeline for many homeowners. As of mid-2025, these alternative products account for 17% of policies in California, Florida, and Texas, up from less than 2% in 2023. New legislation is also attempting to address the crisis. Beginning January 1st, 2026, 9 new laws will take effect in California, establishing wildfire safety grant programs, expanding insurance discounts, and speeding up claim payouts. The Eliminate the List Act requires insurance companies to pay 60% of contents coverage limits, capped at $350,000, to wildfire survivors without requiring detailed inventory lists. But the fundamental challenge remains. How do you insure properties in areas where catastrophic loss isn't just possible, but increasingly likely? The traditional insurance model relies on spreading risk across large pools of policyholders. When entire regions face similar catastrophic risks, that model breaks down. Some experts suggest we need to completely rethink our approach to high-risk areas. This might mean stricter building codes, managed retreat from the most dangerous zones, or government-backed insurance programs similar to flood insurance. Others argue for pricing that truly reflects risk, even if it makes homeownership unaffordable for many. Critical to this conversation are proven risk reduction measures. Creating defensible space around properties, implementing home hardening techniques like fire-resistant roofing and siding, and wind mitigation improvements can significantly reduce risk. Many FAIR plans now offer discounts for these measures, recognizing their importance in reducing catastrophic losses. What's clear is that the current system is unsustainable. Homeowners who followed all the rules, paid their premiums, and maintained their properties are finding themselves abandoned by an industry that once promised security and peace of mind. For millions of Americans living in red zones, the question isn't whether they can find insurance. It's whether they can afford to stay in their homes at all. The American dream of homeownership is being fundamentally challenged by the reality of climate change, and the insurance industry's response is reshaping entire communities. The crisis in red zone insurance isn't just about policy cancellations or premium increases. It's about the collision between how we've built our communities and the new reality of climate risk. Every canceled policy represents a family facing an impossible choice: accept unaffordable coverage, go without protection, or leave the place they call home. As we move forward, the solutions will require unprecedented cooperation between government, industry, and communities. Because ultimately, this isn't just an insurance crisis, it's a fundamental challenge to how we live with climate change in America.